Operators, start earning points with Lamb Weston's all-new Potato Perks app. Simply download the app and start earning points immediately. And right now, as a bonus, get 500 points free just for registering, plus a product rebate up to $100. Redeem your points for goods for your business, like back-of-house smallwares, custom marketing materials, and more. Register today and get your free 500 points and a rebate up to $100. Visit go.lambweston.com/potato perks to download.
Welcome to Exchange Traded Fridays, a weekly podcast from ETF.com, starting first on Twitter Spaces, and you'll catch us later if you miss any of the action. I'm Dan Mika, and with me are my ETF.com colleagues, Jessica Ferringer.
Hey, everyone.
Sumit Roy.
Hey, everyone.
And Heather Bell.
Hey, guys.
So we're going to be wrapping up what's been going on in the markets. And, of course, the big news that has been dominating everything has been the continued invasion of Ukraine by Russia. And we'll just start off with just the kind of the very wacky ETF plumbing stuff that's happening right now with funds like EVRS, the iShares MSCI Russia ETF, RSX, the VanEck fund, FLRU, and also Direction's double leverage Russia Bull Fund, which is due to close. Let's kick it off with Sumit. What have you been just seeing in the past couple of days, and just how crazy quick it seems that all the all the funds that are very heavily focused on Russia have just been going insane with volatility and trading.
Yeah, it's incredible, Dan, what we've been seeing. Both ERUS and RSX have completely collapsed, but things could have been even worse because these ETFs actually suspended creation. So we have massive premiums building in these ETFs. And the thing is, these ETFs don't have the ability to buy the underlying Russian stocks in their portfolios right now. ERUS's portfolio is mostly made up of stocks that actually trade in Russia. And that market is closed, and it's going to be closed until at least March 9th, which is the longest shutdown for the Russian market, basically in modern history. But then we have RSX, and its portfolio is made up mostly of depository receipts that trade in London, or at least they used to trade in London, because most of those have been delisted as of this week. And those depository receipts have also dropped over 90%. Just over the past several days. So without access to those underlying stocks, the ETFs can't create new shares. Presumably redemptions are still an option since they are in kind. So for whatever reason you wanted to redeem your shares, I'm sure they'd be happy to offload some Russian stocks to you. But who would want to do that in this environment? Especially because, like I said, there's huge premiums in these ETFs. Last I checked, RSX had a 550% premium. ERUS had a 7,000% premium. And if you look at ERUS, with a few exceptions, you can see BlackRock has marked down most of its holdings to zero. And the Russian stock market being closed indefinitely, and foreigners have also been banned from selling Russian stocks, even if the market was open. So it's understandable why BlackRock would mark these down so dramatically. And actually, as Heather mentioned to me earlier today, ERUS is actually shutting down today. So this has been a crazy period for these ETFs. And the funny thing is that RSX actually had net inflows of $500 million over the past several days. So a lot of people were actually betting on a rebound in these names, but obviously that didn't work out, and a lot of that money has been wiped out. Do any of you recall seeing anything like this situation before with other ETFs in the past?
Well, I believe the Egypt and Greek funds run by Global X ran into trouble when Greece had their financial crisis, and then when Egypt had the Arab Spring revolution. But that was when the funds became kind of like tools for price discovery in those markets. So I don't know if the same thing is happening now, because how do you price something right now in the current environment? It's just so off the charts.
And it seems to me that there is a very minor precedent, but I think if we just go back just to last late August and September, when China had started to crack down on its tech companies. KWeb, was the value of KWeb was dropping. All of its stocks were being undersold, but I think it ended up, having a ton of inflows just because there was, the speculation that of just buying the dip and trying to essentially day trade it. It almost became a bit of a meme stock in its own right. And I think just looking at the volume in RSX in particular, it's had the highest volume since 2015. And also 2020 as well, but everything had a lot of volume. But this is the highest volume that RSX has seen. I think people were just trying to buy the knife as it was, buy the dip and try to cast the knife as it was falling, and then basically hot potato it to someone else and just try and get in and out of that trade. Since the Russia trade has completely dominated the past week.
Yeah, Jess, you could probably speak to this, but, a lot of times when we see KWeb fell significantly, 50, 60%, a lot of bargain hunters came into that. And then I remember after the pandemic, Jets, the airline ETF, fell dramatically, and a bunch of inflows came into that fund. Sometimes it works, sometimes it doesn't. In the case of KWeb, it hasn't worked. That fund is still sitting at the bottom, but Jets did have a big rebound. So those people made out pretty well. I don't think it's going to work out too well with the Russian ETFs just because things are so much different and there's so much pressure on the Russian economy and the Russian stock market.
Well, the Economist ran a story today that's basically, the headline is the Ukraine-Russia war is wrecking two countries. And I thought that was really interesting because, 20 years ago, Russia was one of the initial BRIC countries. And now it's in a totally different position. And it looks like there's going to be a serious brain drain in Russia. A lot of people are trying to leave the country now because they don't see any hope for recovering from this situation. So I don't know if Putin expected that, but it seems like a miscalculation on his part, maybe.
Jess, you wrote earlier this week on the index provider side, I believe it's MSCI and FTSE Russell have already made it public that they're planning to kick Russia off their indexes. To talk about that and just how swiftly this all came together. I mean, it's head-spinningly quick, just how quick the indexes have decided that Russia is uninvestable.
Yeah, it really is amazing. I mean, I think they both opened it up to get comment on how the investing community was feeling about investing in the securities, and then swiftly decided to effectively price those assets at zero and move them out of the emerging market indices. Now, I don't think it's that big of a deal in terms of how the indexes are constructed because Russia is only a couple percent weight. So it's not going to have a huge impact. But I think just, the fact that this is happening at all is pretty serious. And, these index providers, they tend to review their country classifications about once a year. So I don't think that we'll be seeing Russia added back anytime soon because they do like to make sure that these changes are communicated very well in advance and that they're not making any changes that they're going to have to undo later. So I just feel like the way the situation is going, it might be a while before the country is added back into the emerging market indexes.
Right, and that's where I found this to be, quite a quick twist and quite a real whipsaw. Is just that the index providers really do give as much advance notice as possible. They try to make it very clear that, the index is going to be the index. This is when we're going to start looking at it. They really do all that stuff all in advance. I mean, for example, the GICS reclassification, which might be happening in the next couple of weeks, where we get final that's all finalized. They started that back in October. So we have a lot of lead time to know where some companies may be heading in terms of the sector funds. So to see within a couple of days, two of the biggest index providers say Russia is just, we're not dealing with Russia right now, that's big. Let's jump over to oil, because that's the other really big geopolitical part of this all right now, since Russia is such a big supplier of gas to Europe, and that's putting stress all over the place. I believe earlier this week is the first time in a long, long time that West Texas Intermediate, the U.S. benchmark, has crossed the $100 per barrel mark. Sumit, you were writing about this. Talk about what's happening there and how that affects the oil ETF market.
Yeah, oil is interesting. The West so far has refrained from sanctioning the Russian oil industry directly, but you're still seeing Russia have difficulty selling its oil because A, everything Russia related is toxic today, and B, there's restrictions on companies outside of Russia from interacting with Russian entities. So that's creating problems with regard to financing and cargo ships and all those other elements that go hand in hand with buying and selling crude. Now, Russia exports 5 million barrels per day of oil. So that makes it the largest exporter of crude in the world. And obviously, short term, it's very, very difficult to make up that amount of oil. So prices are just going to keep spiking if those barrels get taken off the market. Long term, we're going to see global oil demand peak earlier than expected because these prices are so high, and we're going to see demand destruction, and you're going to see supply growth start to pick up outside of Russia because it's so profitable to drill for oil with triple-digit prices. But that's little solace, in the short term. If we see crude make a new all-time high above 150 a barrel, that's going to be a major drag on the world economy. But it is going to be good for those oil ETFs like USO, BNO. We've seen those already spike up, anywhere from 40, 50% this year. Those gains are only going to get bigger if oil continues to go higher. But it's anyone's guess where this rally is going to end up topping out.
And the thing is, like, even though there is no specific embargo on Russian oil yet from the U.S. or other major Western countries, traders just aren't buying this stuff because there's too much political risk involved. I believe yesterday there was an auction out for Urals crude, the Russian flagship, and no one was willing to buy it. It got down to, I think, minus 22.70 a barrel. That was the spread compared to the comparable Brent benchmark. So it's really interesting to see that just everything Russian right now is toxic. Even something as in short supply and something that has been squeezed so heavily as this energy commodity. Heather, you had some thoughts?
Well, I literally, like 5 minutes before I jumped on this call, I watched a video by a guy named Mark Zine, I believe his name is. He was talking about how there's been a couple of like sunk vessels or damaged shipping vessels from like Turkey, and I can't remember the other country it was from, but because of that, and this is on the Black Sea, because of that, non-Russian ships can't be insured according to maritime law. So that means that any shipments of oil from Russia are going to have to be on Russian ships. And I think that's a complicating factor because I don't know if they're welcome in many ports right now. Unless I'm totally misinterpreting what I watched.
No, I think a lot of ports would be hesitant to take a ship with a Russian flag on it. But Jess, you mentioned this in our first episode last week. Commodities in general are spiking, not just oil and natural gas, but earlier this week I wrote that there was between Ukraine and Russia, that's a third of all the world's wheat exports coming out. There's some soybean oil that's heavily produced by Ukraine. There's also some tech implications here too, because Ukraine has a lot of neon gas, and you need that neon gas to etch patterns into semiconductor chips. So it seems like pretty much everywhere there's going to be another spike of inflation because of these if we thought that COVID was the mother of all supply chain crises, I mean, this is up there.
Yeah, I also read that 10 to 15% of the shipping industry employees are based in Ukraine or Russia. So there's just so many reasons why I think this will further supply chain headaches. And, I think that lowers the chances that we'll see inflationary pressures go away anytime soon, which really creates a tricky situation for the Fed because you have lower economic growth and more inflation. So what do? I mean, that's the big question. It really does create, quite a predicament for them.
I agree, and that's a great segue into our second topic. We're going to get the Fed meeting, I believe, in a week or 2 weeks or so. And as we're seeing all of this inflationary pressure abroad, the U.S. labor market is absolutely on fire. ADP beat expectations, and we have the job report today. I believe the headline number was 678 new non-farm payrolls, which absolutely crushed the 440,000 that was expected. We're now down to, I think, 3.8 is the unemployment rate. And as COVID continues to decline across the country, a lot of those jobs were coming in in new hires to leisure and hospitality, which were the hardest hit industries in terms of layoffs and shrinking of the labor force. So this creates kind of like a very interesting predicament for Jay Powell. And I think as just like another string in the knot that he's trying to untie here. Because I think if you were Jay Powell, you'd love to be able to say to control what happens in Ukraine and Russia in order to prevent that from adding more inflationary pressure. And at the same time, the Atlanta Fed's latest GDP Now estimate has zero growth, a flat GDP for Q1. We'll see what happens on Monday when they add the latest jobs data. But you've got inflation already at 7%. New wages year over year have increased only 5%. So even though more people are getting onto the payrolls, they're losing aggregate purchasing power. So Sumit, where do you think this puts the Fed right now? It looks like they're still planning for a 250 point, a quarter point hike in March. But how tricky is this situation?
I think it's a really tricky situation, Dan. Nothing has really changed on the inflation front. It's still high, like you said, 7%. And oil prices at more than $110 a barrel aren't going to help with that. But on the other hand, you did have a debate about whether inflation was going to trend down because the supply chain issues were going to get better. So that debate is still out there. But now you're adding a whole another element to the debate, and that's whether the economy is going to slow down because of the Russia-Ukraine situation and all the dynamics that surround that. So slowing economy would dampen inflation, all else equal. So now the Fed has a bunch of different factors it has to weigh. So it has to tread very carefully here. But I think it understands that a 25 basis point hike won't necessarily derail anything on its own. The rates market has already priced in much more than just a 25 basis point hike. So the economic impact from that hike is almost nothing. More interesting and telling is going to be their language and projections. So Powell's going to have to be very careful here. Is he going to be more dovish than he otherwise would have been, given the geopolitical uncertainty? I think he has to be, but at the same time, he can't ignore inflation. So in other words, what was already a really tough balancing act is even more tough for the Fed now. And the risks of a miscalculation have ratcheted up significantly. But I do think, the Fed's going to hike 25 basis points unless something dramatically changes between now and March 16th when they make that decision.
Heather, what do you think?
Honestly, I think they just need to raise the rates. And if it slows down the economy, I feel like they need to do it just to combat inflation. I mean, maybe that's a naive view on my part, but inflation has been such a concern lately that I'm thinking that's got to be the priority.
There was a silver lining actually in the jobs report that you mentioned, Jen. The wage growth we saw was actually flat month over month. So they're still at 5.1% year over year, but that was less than expected. So obviously we want wages to rise solidly, but we don't want them to spiral higher and exacerbate all the inflation concerns. So I think that was kind of a silver lining today from the jobs report.
Jessica, this is less of a question, but more of just a word and kind of and I forget the exact term for like interpretation, but just right off the bat, the stagflation. What's your immediate reaction if when I say that word in this context?
I mean, I think for that you would need high unemployment. That's not something we're seeing. But just in thinking, about how I feel about how this changes the Fed action going forward, I think it does take very aggressive action off the table. I haven't heard anyone mention that 50 basis points hike in a couple weeks. So I think the Fed is going to have to go a little bit slower, and they're going to have to be, willing to adjust to based on what the data is showing as they go on. But I don't think that high unemployment is really a risk or, crashing the economy like that. Like Sumit was saying, I think the 25 basis points hike right now is already priced in. I just think, the projections will be what's interesting and whether they're still going to be able to hike several times this year and how they pace them.
All right. Well, we're going to leave it at that. This has been Exchange Trade Fridays from ETF.com. If you've missed any part of our conversation, you can listen back on Twitter Spaces, or you can catch us wherever you find your favorite podcasts. Just search for Exchange Trade Fridays. We'll have that up relatively soon. But thank you again for listening so much. For Jessica Ferringer, Sumit Roy, and Heather Bell, I'm Dan Mika.
Mary redeemed a $50,000 cash prize playing Chumba Casino online.
I was only playing for fun, so winning was a dream come true.
Chumba Casino is America's favorite free online social casino. You too could have the chance to win life-changing cash prizes. Absolutely anybody could be like Mary. Be like Mary. Log on to ChumbaCasino.com and play for free now. No purchase necessary. Void where prohibited by law. 18 plus terms and conditions apply. See website for details. The voice of the preceding commercial was not the actual voice of the winner.